Hey guys, how's it going? This is Sharil, and you're watching Modest Millennial, where we talk about all things money that they don't teach you in school. In today's video, we'll be talking about what dividend investing is, and if dividend investing is a good strategy for you to reach $1 million in net worth one day. So, if you want to learn about this investing trick that could make you rich one day, stay tuned until the very end of this video. And don't forget to smash the like button and the subscribe button for the YouTube algorithm for more content to help properly manage your personal finances. I post twice a week now, guys, so don't forget to tune in again next week for more content. And guys, if you are just about starting out with your investing journey, there is nothing better than starting it with the help of one free stock from Robinhood when you sign up using my link in the description below. Alright, now with that out of the way, let's start talking about dividends. Let's start by explaining what dividends exactly are, assuming that you have no clue what dividends are and are hearing this word for the first time ever. I was in the same boat 3 years ago, guys, when I started researching and built up my knowledge about the stock market. And I want to help you guys as much as possible. Before we talk about dividends, it is important to understand what happens when you buy a stock. When you buy a stock of a company, that means you're buying a piece of the company. Business owner, am I right? Just kidding, guys, that's not exactly how it works. So, how does it work? A stock basically guarantees part ownership in the financial results of the company, but doesn't give you the right to make decisions for the company unless you have a significant amount of money invested in it. So, if the company performs well, your part of the ownership will perform well and your stocks will go up. If the company performs bad, your part of the ownership will be affected and the stock price will go down. It's as simple as that. But stock price is not guaranteed, right? You might end up losing your entire investment if the stock price plummets to zero. A dividend, on the other hand, is a guaranteed distribution or income on the stock you own. It is basically a certain percentage, known as the dividend yield, of the price of the stock that will be paid to you, either on a monthly or quarterly or an annual basis, depending on the performance of the company. Free money, am I right? This can mean a direct deposit into your investment account anywhere between 1% to about 10% per stock you own. Dividend, therefore, is a token reward, a way of showing gratitude for you from the company that you're buying the stock of. I mean, who wouldn't like that? For example, if you own a stock of Ford, you are guaranteed a dividend payment of roughly 6% on an average every quarter, no questions asked. Alright, don't get all excited and start calculating how many Ford stocks you need to buy to make $1,000 in dividend income each month. Keep watching until the very end to understand what dividends exactly are and how they can be beneficial to you. Dividends are more common to larger, more established companies with regular, predictable earnings and profits. For example, AT&T, Ford, Coca-Cola are all companies that have been around for a long time and will probably be around for another 100 years, with their products being staple in the American market, meaning you will drink Coca-Cola no matter what, and you will drive a Ford vehicle no matter what. These companies are mostly guaranteed to generate profit from their operations, and so they can afford to share some of that profit with their shareholders. Smaller or new companies, on the other hand, such as Square or Neo or biotech companies, can't afford to redistribute their profits just yet, so they keep it to themselves because they are still in their development stage and would much rather allocate those funds for business expansion. Since you now know what dividends are, let's dive into an example of how you can make enough money to cover your monthly living expenses entirely through dividends. Let's say you decide to go with AT&T, for example. A simple Google search will reveal that AT&T stock pays roughly 7% in annual dividends each year. This means that if you invested $100 in AT&T stock at the beginning of the year, you would earn $7 just as a thank you from the company for owning their stock by the end of the year. This does not have anything to do with how the economy is doing or if the stock market is up or down for the year. AT&T will diligently pay you the 7% for investing in their company and trusting their business. Let's say your monthly expenses are roughly $2,000 along with rent, food, and transportation. Your annual living expenses then come out to about $24,000. Don't ask me how. So you would need to have enough invested in AT&T so that a 7% return on your investment comes out to $24,000 each year. Simple math calculation here, and that comes out to roughly $345,000 that you need to have invested in AT&T to cover for your $2,000 in monthly expenses. Easy, right? You can do this calculation for your favorite dividend paying stock just by doing a Google search for what the stock pays in dividends each year, and then dividing your annual expenses by the annualized dividend yield. So let me know in the comment section below if dividend investing has worked for you in the past, and if there are any other companies out there that are better suited for dividend investing in your opinion that I should be looking into. Obviously, just listening to what I just said is pretty convincing, right? That dividend investing is the way to go. Not just yet. There are some downsides to it too. First of all, if the $24,000 in annual income is not your only income, and you make more than $40,000 in combined income as an individual investor for the year, your dividend income suddenly becomes taxable under the IRS law. Your dividend income is now known as what's called a qualified income, which means that you are liable to pay taxes on this income. If your income combined with dividends for the year is between $40,000 and $441,500, which is true of majority of the people in the United States, then you will pay a flat 15% in tax on your dividend income for the year. Guys, I'm all for the social cause of paying taxes and giving a cut from my income to the government. But remember, the more you save on taxes each year, the more and faster your money will grow, and earlier you will be able to retire. There are a couple ways of doing this. So before we move on, make sure to invest in the like button below for the YouTube algorithm and subscribe to my channel so this financial education can pay you dividends in the long run. In one of my earlier videos, I talked about investment accounts that let you pay $0 in taxes from your retirement income, and I have linked that video below in the description. So if you need more info on tax-free investments, please check that video out. But basically, there are two ways you can go about these. The first way, obviously, is through a qualified workplace 401k plan. Investing in a traditional 401k plan comes with the advantage of investing pre-tax dollars, which means that your money will automatically be contributed to the 401k plan before any taxes are deducted on it. And it will grow in the 401k plan completely tax-free, which means that no taxes on capital gains or dividends until you start taking distributions from it after 59.5 years of age. The other way is to invest your post-tax dollars in a Roth IRA and let it grow without taking your earnings out until you are 59.5 years of age. After this, any money in the Roth IRA is completely tax-free and yours to keep. You can earn dividends through a brokerage account too. The downside to brokerage account or a non-qualified investment account, though, like I said before, is that your dividend income in these accounts will be subject to taxes at the end of the year. Now, going back to the topic of the disadvantages of investing in dividend stocks, we have a prime example of what could have happened to your money if you just chose to stick to dividend stocks for your investments. Ford in 2020, due to declining car sales and the economy shutting down, decided to stop paying dividends on its investments for the foreseeable future until the economy got back on track. Last I checked, Ford was still holding back the dividend payments even after an entire year has passed by since the shutdown. There are two downsides here. Number one is that all the money you invested in the company to earn dividends that would pay for your living expenses each month now is not earning you any dividends anymore, and suddenly you would be forced to find alternative means of making money to cover for those expenses. Number two, and you should take extreme caution when it comes to investments like these, is that as soon as Ford announced that they are cutting dividends to zero for the foreseeable future, their stock started tanking, and it tanked really hard until it reached about $4 a share. Now, some might consider this as an opportunity for buying more and averaging down on the price of the stock. But at the same time, if the stocks you own costed you about $9 to $10, this kind of situation can be scary and would make you reconsider if you should hold on to the stock or seek alternative investments. This is unfortunately true about investing in stocks of individual companies that may be impacted heavily when the market shuts down, like it did last year. General Electric, for example, announced restructure of their entire business and cut dividends by 50%. GE has been around for more than a century now, and for an old company to cut dividends like that and restructure its operations sent shockwaves to the market, causing a massive sell-off in GE stock, and the price of their stock hit rock bottom. This is why I tend to invest in index funds instead. For those of you who don't know, index funds are like owning a basket of stocks with the basket containing growth stocks from a bunch of different companies. So if one company was to underperform, the other companies will kind of average out the downfall of that one company. Index funds pay less in dividends than dividend stocks do, but you are not entitled to pay taxes on this growth unless you sell the stock at some point in the future. Now, of course, some of this growth does come from dividends, but their dividend yield is about 1 to 2% per year and is much less to cause any dent in your savings when tax payments come due at the end of the year. So, guys, there you have it. Dividends are a great way to make passive income each month that will support your monthly expenses and will reduce the amount of work you have to put in at your job as your investments keep growing each month. At the same time, there are tax consequences of relying on dividend income only. So make sure to check with your financial advisor and your tax consultant to get a complete picture of dividend investing. Also, thanks again for watching this video, guys. I really appreciate it. And as always, don't forget to smash the like button for the YouTube algorithm, as this helps out the channel a lot. And this one trick can save you or earn you hundreds of thousands of dollars in the long run. And please also don't forget to subscribe to my channel for more content on personal finance.